Wall Street may soon face one of the biggest IPO waves in history. SpaceX, Anthropic, and OpenAI could all come to the stock market within months. SpaceX may raise around $75 billion. Anthropic and OpenAI may each raise up to $60 billion. Together, these listings could add up to $4 trillion in market value. So the big question is simple. Can the US stock market absorb such huge companies? The answer is probably yes in the beginning, but the bigger risk may come later. These IPOs are huge by normal IPO standards. For comparison, Saudi Aramco raised $29 billion in 2019, which was the biggest IPO at that time. These three companies together may raise around $200 billion. That sounds massive, but compared with the US stock market, it is still small. The S&P 500 is worth around $65 trillion and the Russell 3000 is worth around $77 trillion. So even $200 billion is only a small portion of the full market. This means there should still be enough buyers. The market can likely digest the IPOs at first. Index funds may also not feel a huge impact immediately. This is because most indices do not count the full company value at the start. They usually count only the free float. Free float means only the shares that are actually available for public trading. For SpaceX, the first public float may be around $75 billion, even if the total company value is around $1.8 trillion. So its initial weight in the S&P 500 may be only around 0.1%. In the Nasdaq 100, it may be around 0.5%. So yes, index funds may need to buy quickly, but the first impact should still be manageable. The market will not get all the shares on day one. This is because of something called as a lockup. A lockup means insiders, founders, and early investors cannot sell their shares for a certain period. So at first, only a small part of the company is available for public trading. For SpaceX, the initial free float may be around 4%. Later, after the quarterly reports and release dates, more shares may slowly enter the market. Some insiders may sell 20% of their stakes, then another 10% if the share price rises enough. Elon Musk's stake may remain locked for 366 days. So the supply of the shares comes slowly, not all at once. The real risk is not whether the market can absorb these IPOs. The real risk is whether investors overpay. History shows that the many IPOs disappoint after listing. On an average, IPOs have underperformed the broader market by around 20% percentage point over the 3 years. Very expensive IPOs, especially those valued over 40 times the revenue, have done even worse. SpaceX could list at more than 90 times the revenue, which is extremely expensive. Also, big IPO booms often happen near hot market peaks. So excitement on listing day does not always mean good returns later. The bigger long-term risk is a capital diet. For many years, tech companies bought back shares that reduced share supply and supported stock prices. Now the situation may be changing. Tech companies are spending heavily on AI, reducing the buybacks and raising more capital. If more companies issue new shares, the supply of shares increases. At the same time, the market is already heavily dependent on AI related companies. The top 10 AI related firms account for around 40% of the S&P 500 value. So bad news for one IPO may not hurt that much, but bad news for AI as a whole could affect the entire market. The simple message is this: investors may get excited about their Giga IPOs now, but a few years later, the market may need a capital diet. Thank you.